Hi, and welcome to another episode of Monday Market Outlook. It's been a quiet couple of weeks in the markets until some good economic numbers came out that gave the market some breath. First, CPI numbers came in cooler than expected. CPI data decreased to 5% versus a 5.2 expectation. Not only that, PPI numbers, the producer price index, posted its biggest drop since the start of the pandemic. Now, as we all know, that the producer price index is a forward indicator of CPI and inflation rates. So a lower manufacturing cost also means that we may see lower inflation data coming in the next few months. To add to that, the initial jobless claims numbers came in at 239,000, which is 11,000 higher than previous readings. This indicates that the labor market is tightening. Of course, a tightening labor market means that wage inflation may also be starting to come down. Locally, we also see Philippine inflation coming down from a high of 8.7 to 7.6 a couple of weeks ago. CPI numbers last week also came in softer, 121.1 compared to 121.4 during the previous months. Also, BSP Governor Felipe Medalla came out with a statement saying that the BSP is now more likely to pause its rate hikes on May 18. Now remember, our interest rates currently sits at around 6.25. So a pause in the rate hikes this year would be welcome news for the markets. Let's look at the PSEI chart here. We see the market settling at around 6,481 on Friday after a slew of favorable economic numbers coming in both globally and locally. We have a couple of nice rejection weeks here, which shows that the bulls are ready to come in every time that the market touches or gets close to the 0.5 Fibonacci level. A market close on Friday at 6,480 gives us a good reason to be bullish on the PSEI next week. Now we might see the PSEI again making a challenge on this critical zone here at around 6,550. Let's see how the market reacts on that critical zone, whether it can break out of that zone or retrace back to the 0.5 fib. Going back to our stock picks, as we recommended for this year, it's best to stay defensive. Of course, the banks are an attractive pick. We have BDO, Metrobank, BPI, and Union Bank. Union Bank currently consolidating here at around the 85 level. Let's see if this is actually an accumulation, and hopefully we can see Union Bank make a move towards its 89 resistance. Of course, our defensives AP, SCC, and DMC, right? So SCC not looking good here. It looks like an island reversal. So as it has already broken down from its 29 support level, we may see Semirara move to its 2690 support level. So let's see how Semirara performs this week. DMC able to hold its support level at 1072. Congratulations to those who were able to get Apex. It has reached our target price 2.61, but let's wait for its reaction at this level to top slice and take profit from this spectacular rally. A-REIT has gone down to 32, right? Now at this level, the yield for A-REIT is already 6.5. It's much attractive than the 6.1 yield where it was when it was at 36. Why is the price of A-REIT going down? Remember that REITs move in coordination with the interest rates. Interest rates are currently at 6.25%, which is more attractive. A 6.25% time deposit or a bond, or a REIT that gives you only 6.1%. Of course, bonds will become more attractive. As bonds become more attractive, the price of REITs will adjust. Of course, the price of REITs usually adjust accordingly and would settle at a price level where the yield becomes at par or more attractive than the yields being given by alternative assets. At 6.5, which is now more attractive, a 6.5 REIT or a 6.25 bond. REITs at 32 becomes quite attractive, and given that the BSP might pause rates, we may already see A-REIT hitting a bottom of 32. So another defensive stock you may want to consider would be Manila Water. Now Manila Water looking looking good, forming a wedge formation here. It has a potential to break out of this downtrend line. Last Friday, we also saw the kickoff of first quarter earnings. The bank started their earnings season with JP Morgan, Wells Fargo, and Citigroup reporting favorable first quarter results. This moved the S&P 500 to 4150, well above the options wall of 412. We were anticipating the market to test its 405 support, but instead it tested its 407 support here. If we look at the two-hour chart, we can see the bulls coming into the market every time the S&P touches 407. Now going back to the daily chart, the market is currently sitting at its trend line resistance. So we have a downtrend line here. And whether this is a breakout or a fake out remains to be seen. Looking at the candle from the last day of trading, there seems to be an indecision here as the market may be looking for more data coming into next week's earning to determine whether it wants to test its resistance here at 4,200, and if it does break out of 4,200, we may see the market going towards its upper critical zone at around 4,280 to 4,300. Now remember, we plotted a couple of critical zones here, upper critical zone and the lower critical zone here at 3750. There's no sign that the market is moving towards its lower critical zone here. So the market is currently quite bullish here, and there seems to be more reason for the markets to become bullish next week. Looking at the options expirations chart, we have 4.4 million options expiring on the third week of Friday. This is always a big options expirations date for the markets, with a maximum pain of 401. So this is the maximum pain level here at 401. The market is currently at 415. So there doesn't seem to be a big call wall here, which may suggest that the markets may move towards this direction. Of course, a lot of people very bearish on the markets, and that's the thing with the markets. When everybody's thinking that it's going to go down, what does the market tend to do? It tends to go up. Looking at the earnings schedule for this week, we have banks continuing their earnings calls. Bank of America, Goldman Sachs, and Morgan Stanley all reporting this week. We will also see tech stocks kicking off their earnings season with Netflix, IBM, Lam Research, and Taiwan Semiconductors, as well as Tesla, coming out with their quarter one earnings results this week. So it's going to be a blockbuster earnings results. Let's see how the market reacts to it. Last year, the buzzword really was inflation. So week in, week out, we were looking at inflation numbers, right? CPI, PPI. And that story has already run its course. Now this year, the buzzword really is earnings. So the market is anticipating earnings more than inflation because it's the earnings results that will drive the market towards a specific direction. Currently, if we look at the PE ratio of the S&P 500, it's currently overvalued. Current PE ratio of the S&P is around 22. The current PE ratio of the PSEI is at 14. Now, 14 is quite undervalued compared to its 10-year average of 19. Now, how does earnings come into market valuation, right? So remember, it's price to earnings ratio, which is why earnings is going to be a big thing. Now, a bit of a primer on earnings. If you look at what the PE ratio means, it's a price to earnings ratio, right? So ratio is comparing a couple of numbers. Now, the price is the price of a stock, or if it's an index we're measuring, it's the summation of all the prices of the stocks in that index. Now, for example, the price of your stock is 14 pesos, right? Now, what is the earnings per share of that company, or the sum of all EPS for the last 12 months of all of the stocks in that index? Let's take, for example, for simplicity's sake, we'll put the earnings per share at 1 peso, right? So the PE ratio is basically 14 divided by 1, right? So how does the PE ratio, or why is earnings important when looking at the valuation of the markets, right? Given that the price is still 14, and now we have to compute for the forward earnings per share, right? Forward earnings per share means that given that we are currently at a high interest rate environment, right? So most companies with interest exposure, this is going to affect their net income margins, right? Because costs for interest have become high. Also, given the fact that when we enter into a recessionary period, you would have a slowdown in economic activity. Consumers may not be able to spend as much as they did before, right? So given lesser consumer spending and higher interest rate cost, how will companies' earnings look like in the next quarters, right? So it's safe to assume that when earnings take a hit, the earnings per share of the company goes down significantly. Like for example, if it goes down to 70 cents instead of 1 peso earnings per share, right? So this is a 30% drop in earnings per share. So if we divide the price and earnings, we get a ratio of 20. So a PE ratio of 20 in the stock market, in the Philippine stock market, it's already above its 10-year average. So it becomes expensive. Given that earnings will go down and give the market an expensive valuation, equities in the future may become less attractive. Now let's look at this chart. This is the equity risk premium chart from Morgan Stanley. Now what equity risk premium means is that what is the premium that I'm paying to invest in a risk asset as compared to the potential earnings I can get from an asset that is risk-free. Now, what are risk-free assets? These are your government bonds or treasury bills, etc., right? So they're considered risk-free because they have the full faith and credit of the government behind those instruments. If interest rates here stay at 6.25%, so you're getting a yield of 6.25% on the risk-free assets. In the US is 5%, right? So if you compare that yield, 6.25, risk-free, as compared to a stock or an equity with risk associated with it, what's the yield there given that their earnings will go down? What this chart is basically saying is that the risk premium or the additional yield that you're getting, the premium that you're getting by investing in a riskier asset is just 150 basis points or 1.5%. Right? So as an investor, you have an asset that gives you 6.25% risk-free as opposed to an asset that would give you 7.75% but with risk. Which one will you choose, right? So the 6.25 risk-free asset now becomes a lot more attractive to investors, right? So given this chart, remember this chart is basically adjusting for the impact on earnings given economic headwinds in the next few months. If earnings go down significantly in the next few quarters, the attractiveness of equities become less, and we may see investors moving out of equities into risk-free assets. That's why analysts are saying that we may see a potential drawdown in the stock markets in the next few months, depending on how earnings would look like for companies affected by high interest rates and given lesser consumer demand. So let's continue to monitor earnings as they come. So make sure you subscribe to the channel to keep up to date on the earnings results. So I hope you like this video, subscribe to our channel. Now, good luck on your trades. Remember to manage your risk accordingly, and I'll see you again next week. Thank you and bye-bye.